Apple just dropped a record quarter, and the headlines are all positive. But for you, the investor, the real story isn't that big revenue number. It's a tug of war happening inside the company, between the explosive growth of its most profitable division and a really concerning slowdown in its most important growth market. Understanding that tension is everything.
So here it is, $102.5 billion in revenue for the quarter. I mean, it's a massive number, a new record for them. But honestly, this number doesn't tell you where Apple is strong, and it definitely doesn't tell you where it's vulnerable.
So where is the real story for us? It's not in the total sales, it's in the quality of those sales. And the geographic trends that are flashing some major warning signs and also some huge opportunities.
You see, this entire earnings report really boils down to two things. First, you've got the unstoppable growth of their highest margin business. And second, you've got the surprising, kind of concerning weakness in what was supposed to be their biggest growth driver. These are the two narratives you need to follow.
Okay, let's dive in and set the stage. On the surface, yeah, the headline numbers looked great. By any traditional measure, it was a very successful quarter. So, looking at the key metrics here, Apple delivered. Total net sales were up a solid 8% year over year. That's exactly the kind of steady top-line growth the market wants to see from a mature giant like Apple. And here's how that revenue pie gets sliced. No big surprise, the iPhone is still king, right? It makes up almost half of all sales. But look at that second slice, services. It's now way bigger than Mac, iPod, and wearables combined. This is not a side gig anymore. It's a central pillar of the entire company.
And that brings us to the first, and frankly, the most exciting part of this story for investors. The services division isn't just growing, it's quickly becoming the main profit engine for the entire company.
I mean, this chart says it all, doesn't it? While product revenue grew a perfectly respectable 5%, look at services. It exploded by over 15%. All the momentum, all the acceleration, it's clearly shifting towards that high-value, recurring revenue, not just selling a box one time.
And the reason this is so incredibly important comes down to one word: margin. For the whole year, Apple's hardware, the iPhones, the Macs, had a healthy gross margin around 37%. But services? A staggering 75.4%. It's not even in the same league.
So here's the crucial takeaway. For every single dollar Apple brings in, they make more than double the profit from services than they do from selling a physical product. This is a fundamental shift. It's reshaping Apple's entire financial model into this high-margin, predictable, and incredibly profitable machine.
But that amazing growth story gets a little complicated when we look at the second narrative. This is the big red flag in the report, the headwind that investors absolutely have to watch: China. Just take a look at the sales by region for the full year. Americas, up 7%. Europe, up a strong 10%. Japan, up an incredible 15%. Rest of Asia Pacific, up 10%. You see the pattern, right? Solid, healthy growth everywhere, with one glaring exception. Greater China sales actually fell by 4%.
And this really puts it in stark contrast. While a mature market like Europe is posting double-digit growth, the one market that was supposed to be Apple's next-grade frontier is actually shrinking. The key question for investors now is this just a temporary blip, or is this the beginning of a much more serious long-term trend?
Now, despite that challenge in China, let's be crystal clear, Apple is still an absolute cash-printing machine. And for us as investors, what they do with that cash is just as important as how they make it.
In this fiscal year alone, Apple generated over $111 billion in cash just from its operations. I mean, that is an almost unimaginable amount of free cash flow.
So what did they do with it? Well, first, they spent nearly $91 billion just buying back their own stock. This is a direct move to boost shareholder value. It reduces the number of shares out there, which makes every share that's left just a little more valuable. And on top of that, they paid out another $15.4 billion directly to investors through dividends. It's a massive, direct return of capital right back to shareholders.
Okay, so let's boil this all down. What's the bottom line for an investor? If you're going to track Apple's performance, there are really only three critical things you need to watch going forward.
First, keep your eyes glued to services margin growth. As long as this super profitable business keeps growing and keeps those high margins, it can hide a lot of other problems. Second, the Greater China sales trend. Is that 4% drop a fluke, or is it a real problem? This is your key risk. And third, the pace of share buybacks.
Think of this as the floor under the stock. It shows management's confidence, and it's a direct driver of EPS growth. And all this leaves us with one final and kind of provocative question for the long term. Look, Apple's massive valuation has always been built on the promise of the next big thing. But as this high-margin, predictable services business becomes the real core of the company, can any new gadget, no matter how cool or innovative, truly move the needle for a company this huge? That right there is the strategic challenge Apple now faces.